Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. In the background, so I've gone over a couple of different things. I've said that commodities are priced off of two different things. Inflation, and then the second portion is supply and demand, which is the ratio compression against gold. Or the CRB index in its compression against stocks. And we're seeing that the CRB index is compressing against stocks. That's why that ratio is starting to turn. We're seeing it break out of its pattern to move and compress. See the commodities compress against stocks. What I have behind me now are market balances. Market balances are what drive commodities, whatever commodity it is, against gold. It compresses that ratio. So gold, if you look at it this way, gold goes up and down based off of its accounting measurement of money in the system. If gold accounts for the money in the system, it goes up. And it only accounts for it under certain market conditions, namely real negative rates with an increasing interest rate environment. That's the time it accounts for it. At the same time, commodities, individual ones against gold, as this goes and accounts, this guy is going to account for it and compress its ratio against gold. Looking at market balances is what gives us the best picture of what commodities will probably perform the best during the next bull market. I have a couple behind me that I think are pretty good. So we've got in the upper left-hand corner here, this here is the uranium market. So we've got uranium in millions of pounds. We have the deficit, which is the negative portion here in the red. The gray is a positive surplus balance. We want to see a negative deficit going out into the future, and that's what we're seeing in this projection here. So uranium more than likely is going to move higher because we're going to come into a deficit of uranium. Another one, and I couldn't find a chart for oil, but Goldman Sachs sees the oil market to see deficit of 5 million barrels per day by end of 2021. Oil major total sees 10 million barrels per day supply gap in 2025. They say, and that's true even if you take very cautious view on short-term demand recovery and on future demand levels. Christofferson added, noting that a 10 million barrels per day gap in supply between now and 2025, that's a massive shortfall of supply to cover in just a very few number of years. We have copper here, growing deficit. CRU expects copper market to go into deficit in 2021. It's exactly what we want to see as an investor. We want to see deficits. Here it says, without project supply gap will exceed 15 million tons by 2035. The gap continues to grow as time goes on. Here's some companies that they like for investment. Codelco, Freeport, Glencore, Grupo Mexico, which is Southern Copper, BHP, First Quantum, Rio Tinto, Antofagasta, and MMG. Here's the platinum supply demand balance. This is inventory on the bottom. 4.3 million ounces, 2.1 million ounces, and it just continues to decline with deficits being projected in the future and in the past. This is a little bit old of a chart, but we're running deficits. Here's palladium. Palladium, look at the inventory of palladium over time. It just kept getting drawn down, which resulted in higher and higher prices of palladium. This was at $1,000. It's now at $2,500 because inventories are getting eaten up. Inventory of platinum continues to get eaten up. This only goes to 2015. But I suspect over time that the inventory, because of the market balance of platinum, and I've got another one over here, where we continually run deficits in platinum, which will eventually eat through this inventory. The eating through the inventory is going to raise the price of platinum and compress that ratio against other precious metals. It says this analysis gives a forecast annual deficit of close to 250,000 ounces between 2016 and 2021, suggesting that market fundamentals should support higher prices over this period. So that's what I have for some of the market balances. I didn't do all of them. Nickel looks pretty good. I would say platinum is my favorite precious metal, along with silver. Those two I like a lot. Gold is pretty good. Looking at the production, gold is about to peak, or has peaked. Platinum peaked in 2006, and we're starting to head lower in platinum production. Copper could have peaked. Depends what projects they can bring online to bring on supply, but it might have peaked. We'll see. A lot of these metals are going to be peaking in between now and 10 years, or are just have peaked. Which means no matter how much money there may be some that no matter how much money you throw at it, you're not going to raise the production level ever again. Unless you go mine it off of an asteroid or another planet or something. But again, we'll see. We'll see what happens. I'm kind of loading into some of these physical metals because that's the value in society. The value is in the natural resources that create products for people that people value and create value and utility to society. They're not in financial instruments, in my opinion. I think those over the next 40 or 50 years, we're probably going to run into shortages of materials. The dollar is based off of it's based off of growth of our currency system. What backs the currency system is an ever-expanding energy supply, and growing energy supply is required if you want to grow the materials that you're mining out of the ground. If you hit a constraint in energy supply or oil, or current oil system, we are going to see less growth in minerals, less growth in whatever it is, which will collapse the currency systems. If the currency systems collapse, this is a ways out, guys. Or maybe it's not a ways out. If the currency system collapses, what stores value in this world? Real estate, fine art, and precious metals. Everything else has gone to zero. If it's harder and harder to get precious metals, I would think that precious metals would demand a premium. But we'll see. Maybe I'm wrong on that. Maybe everything will continue to go as normal, hopefully. But most everything in this world is nothing more than converting energy into products. That's it. Your energy system is the most important thing in this world. If you go into an energy scarce world, oil will become increasingly valuable. Coal will become more valuable. Natural gas will become more valuable. Uranium will become more valuable. And guess what? If you're part of this channel, you're probably buying all of these assets at a very close to the bottom area when I started the channel. So if those provide the most value to society, then guess what? They're going to be priced as such at some point, whenever that is. Now, another thing to keep in mind is if energy becomes more scarce and you've got earth between you and minerals, obviously the minerals will become incredibly valuable. Because of that, between you and that mineral is a bunch of earth for mining companies. It takes a lot of energy. As ore grades continue to decline, that energy is going to be, if the energy price goes up, means the minerals will go up. If you invest in mining companies, just mining companies, they may not make more money in this bull market than they did before because now you're playing the differential between the cost to produce it and then the cost of the mineral itself, the value of it. One way to reduce your risk is to buy the physical metal itself. Just bypass all the risk, get the physical metals. And that's one reason why I hold such a large physical metals holding. Roughly, I think it's 20 to 25% of my entire net worth is in physical precious metals. Because of these risks. Because of nationalization, because of oil or energy scarcity, because of all these risks that are out there, because of tax risk. If we have problems with our currency, they're going to start taxing everything. I'm kind of off the grid. Now, another spot is energy itself. So I invest very heavily into energy because I think energy is going to get a lot more expensive. The mining companies, I'm not as heavily invested in. I do have some money, but I'm not as heavily. I'm in royalty companies where they get a percentage based off of volume, and price is really what drives those companies higher, not input costs. They don't have any input costs. It's very small input costs. So I prefer the royalty companies over the mining companies because of the energy input costs. And really, you're playing the delta between the mineral cost and the energy cost for a mining company. A royalty company, you're just playing volume and price. It's basically a leverage bet against the mineral price, as long as they can produce a good volume of that metal. So that's been my strategy. Royalty companies, energy companies like uranium, oil, natural gas. I know there's a lot of people who like coal. I didn't really get too big into coal. I don't have any investments in coal, but that was a really good pick for those who chose coal. Good job. And these minerals, I'm buying physical platinum, physical silver. I own a lot of it. I do have physical gold as well. Copper, I have royalty companies in the copper arena. Franco-Nevada has copper and precious metals. I own Wheaton Precious Metals. I own EMX. I own Nova. I own gold royalty, uranium royalty. I own basically all these royalty companies, a lot of them. And I've overweighted them. Yep, and here's uranium. I do not own any royalty companies in oil. I own the exploration and production companies, the high debt, high leveraged ones. SM Energy, CDEV are my two favorite. Recaf is showing to be a very volatile, good one, I think, for this move. CPE, I own a whole bunch of other ones. GTE, Crew Energy, MCF, Birchcliff. I own a whole bunch. Athabasca Oil, Ontario Resources, Southwestern Energy, goes on and on and on. I'm pretty diversified in the energy space. So I'm pretty happy with my holdings. So I just wanted to cover what the supply-demand balance, what we're looking for is market balances. We want to see deficits going into the future. This will compress the ratio against gold. This will get us where we want to be. These are some, as an example, of ones that I do like. If you guys like this content, give me a thumbs up. Thanks for listening. This is Finding Value.